Hello and welcome. We are Group 6, and our chosen currencies that we will be discussing today are the Australia dollar against the US dollar and the Australia dollar against the Great British Pound. The areas that we will be covering today are the interest rates, inflation, GDP, and the exchange rate expectation. So in recent times, the RBA has dropped interest rates from 1.75 to 1.5, and this is the last time. This is the last time that they've decreased interest rates from 0.25. This also shows a downward trend since 2010, when the RBA has last decreased the interest rates. This has been recently due to inflation figures, and they've also adopted an expansionary policy. Since February 2016, again, it's also dropped 50 basis points in order to stimulate the economy and encourage growth. The 3-month forecast is a trend to keep holding, as well as reducing interest rates. Again, figures in regards to inflation and growth, they will come into consideration when holding or decreasing interest rates. Again, the rates were last increased in 2010. So it's safe to say that the interest rates will continue to decrease. So the GDP. So the UK has maintained a steady interest rate of 0.5%, but recently in August they have decreased interest rates by 25 basis points due to the effects of the Brexit, which is also at an all-time low. This is an effort to calm domestic markets and encourage economic growth. So when the Brexit occurred, investors changed from the pound to the USD, which led to less risks. As a result of this, the demand of the pound decreased, and the USD increased, which will lead to a depreciation of the Great British Pound. So the 3-month forecast, the Bank of England will continue to buy government and corporate bonds in an effort to stimulate the economy and calm domestic markets. The last time interest rates were changed was in March 2009, which is a while back, and ever since then it was holding at 0.5%. More cuts are likely due to uncertain relationships between the UK and the European Union, and the impact of Brexit may not show up until later down the track. Danish central bank Lars Roed, with an interview with Bloomberg, said it was difficult to forecast what the development will be in 2 to 3 years ahead. And the impact of the Brexit may not show up until later down the track. So the outcome of the currency, since the UK has a lower interest rate than Australia, investors will wish to invest their money somewhere where they would get a higher rate. As the UK has decreased the rates lower to relative to the AUD, GBP is expected to depreciate. A drop in the interest rate discourages capital inflow, decreasing demand for GBP. It also encourages capital outflow, increasing the supply of GBP. Therefore depreciating the currency. So just in relation to this graph, interest rates of both GBP and AUD have decreased, so supply will increase of this currency and demand will decrease relative. In the future, both will depreciate, but not by a lot, as shown in this graph. So they were currently here, currently there, and the red lines are the new effects. So the USD Federal Reserve have increased interest rates by half to 5.0% in late December 2015, are expected to hold rates until December 2016. The Federal Reserve have adopted a tighter monetary policy due to weak retail and industrial production figures, the global capital economist Paul Ashworth was quoted saying, "It makes a lot of sense to wait until December until putting the rate trigger due to uncertainty and a pickup in the GDP growth in the 3rd quarter." So the 3-month forecast is steady and expected to hold until December 2016 due to uncertainty in the GDP growth, and also due to the upcoming US election in November may cause uncertainty. So it depends who, Hillary Clinton or Donald Trump, gets it. Business and consumer confidence will be affected. And it's hard to know in a positive or in a negative way. So the outcome of the currency, a high interest rate encourages investors to buy USD, as they will receive a higher return on the investment than previous. A rate hike encourages capital inflow and increases demand in the USD. It also discourages capital outflow, decreasing the supply of the USD in the FX market, and is likely to see an appreciation in the USD. So with this graph, the blue stipulates our current area, so that's our equilibrium, and the interest rate of the Australian dollar has decreased. So supply of the AUD has increased and demand has decreased. So further down the track, in 3 months, the USD has increased the interest rates, and the AUD will be likely to decrease the interest rates. The range will change, but not by a lot. And in the future, the range will be larger than the GDP diagram shown earlier.
The Australian inflation rate right now it's 1.0 percentage, and then US is 0.84, and UK inflation rate is 0.60. As you can see, the Australian inflation rate is higher than both the other country inflation rate. The inflation of Australia is right now almost twice as much as more than UK. So this means that goods are relatively cheaper to import than to export to that country. So this would lead to the lower demand of AUD because of the decrease in export, and then greater imports will result in a higher supply of AUD. So this would increase the supply curve, and then decrease the demand curve to the left. This would in the future will result in the exchange rate decreasing. It is forecast that as current currency AUD to USD is 0.85, AUD to GBP is 0.858. So the forecast for 3 months is going to decrease to around 0.55. And AUD relative to USD, it's not as much far apart as USD compared to GBP. So goods are to be exported from United States to Australia. But then according to the purchasing power of parity, the price of goods will eventually equalize. The exchange rate is adjusted, resulting in the equalization of the effective price of goods. So the thing that can happen, another thing is that instead of these going into effect, the actual price of goods can equalizes. So the inflation rate will equalize due to the interdependence of exchange rate and inflation rate. The forecast for the 3 months is that AUD will depreciate against USD to about 0.74. Here you can see that the supply curve is increasing and shift to the right, and then demand curve shift to the left, resulting in ER changing a bit down.
Basically on the research of the OECD and RBA, they gave us the results that both AUD, USD, and GDP will be increased for the next 3 months, and Australian probably will increase from the 2.58 to 2.89, and US will be increased from 1.89 to 2.21, and UK probably will be increased from 1.7 to 1.96. And also we will talk about something about the Brexit effect. Right. The first graph we gave is to AUD against the USD. The blue line is showed us for the current position for AUD to USD, which they both on the higher level of the GDP increase the demand of the input, so increase the supply of the AUD. On the other side, increase the overseas borrowing will increase the demand of the AUD. In the future of the 3 months, we believe the AUD depreciation will be lead the overseas borrowing higher than the demand, higher than the supply. So that's why we think from the GDP side, the exchange rate will be increased in the next 3 months. So for next one is AUD against the GBP. Also, the blue light is shows the current position, and we believe the AUD and the GBP will be both depreciation in 3 months, but the AUD probably will be depreciation more, which means to lead the export more cheaper and make the demand of the AUD bigger than the GBP.
This is the conclusion that we have come through from the factors that we have considered in the slides. The decrease in the interest rate in both Australia and British pound will lead to a depreciation. Increase in US interest rate will cause a appreciation in the USD. Due to the in Australia inflation rate being higher than both USD and GBP, AUD will most likely depreciate against both currency in the foreseeable future. Australian dollar to US dollar forecast for 2016. The forecast of beginning of December, it's 0.76. Maximum rate is 0.77, while minimum is 0.74. Average rate of the month is 0.75, and the inflation rate at the end is 0.75. The percentage change for December is negative 1.32. Thank you, and this is our reference for all the informations. Thanks.